Hey everybody, this is Jose Blasco. We are about to get started in 20 something seconds. This is a sound check. As always, a quick message on the chat box would be appreciated. That would tell me that you hear me well, sound is good, and we are ready to get started. So please go ahead and just say something nice. Just a quick hello would do, but anything else works too. And in the meantime, I will turn on my video stream so I can say hello here from my corner on the screen and ready to get started in just a few seconds here. Very good. Perfect. Yeah, perfect. So I see your confirmation, guys. So wonderful. Thank you so much. How are you, Joe? Thank you for your confirmations, everybody. Welcome to the session, the top session. Today is November 21st, 2021. My name is Jose Blasco. And before we get started, as always, I would like to highlight the disclaimer on the upper left side of the screen. So please read it carefully. This is indeed important information. Read it completely, as always, even though today the market is closed. It's still important because what we learn is then to be applied to the markets. Okay, so make sure you understand the financial risks associated with trading and therefore read the disclaimer carefully, please. Fernando, how are you? Mark, good to see you as well. Yes, good morning, Ferrari. Anyone else was watching the race in Qatar? It just finished a few minutes ago, and I have an extra smile on my face today. Fernando Alonso, since 2014, was not in the podium, and today ended up third. So amazing. Very, very happy. But don't ask me about it because then instead of a top session, it's going to be a Formula One session. So we better focus on our plan, which is to talk about the platform, obviously. Often we talk about characteristics of the platform, and then of course we cannot discuss certain technical aspects of using top without talking about trading. So sometimes you have a little bit of a lecture built in the use of the platform as well, depending on the subject that we're addressing. Okay, in any case, feel free to ask questions at any moment in time, and indeed delighted to do that. Okay. See, Christian, I see that it seems that you're having problems with logging in the website. I would not know why would that be. Unfortunately, at this time, since we are live already on the session, I cannot contact my support team to have some sort of a reset. I'd suggest maybe you open an incognito window on your browser, and that may do in case some cookie or something got stuck. But if any, I'll check later on. In the meantime, good to see you are connected on YouTube, and we're gonna run the session fully, so not a worry for you, Christian. Okay, thanks for the message. Yes, and Mark, indeed, this is a Ferrari shirt because my other driver I support is Carlos Sainz, which drives for Ferrari. So yeah, you can see my Spanish side there. Caught me. Anyway, so let's begin the session. A quick one before we start. I'd like to again one more time point at tradewithufos.com/Jose. This is the place where you should go anytime you have a question, so you can post the questions here. You need to log in first, and then you can click ask question to post your questions. Then the questions show below the way it shows here, where everybody could actually comment and interact on those questions. Of course, our support team will be answering your questions, and therefore here you can get your questions and your answers, as well as searching in the search box for prior questions that may have been asked by other members of the Trade with UFO community, which may happen to be the question you want to ask about, and therefore your answers are ready waiting for you. Today, of course, we are talking about top, so this is our TRADDICTIV Options Planner. You also have here your subscriptions options here right in front of you, easy to access. But as you know, our technology is available in other platforms too, so you can go ahead and take a look from here. Okay, with all of this said, so let's get in top and let's continue where we left last time. So in our last session, yes, thank you for that, Christian. So in our last session, we were looking at studies. We were exploring the studies on the upper part of this panel, and we stopped there with Ichimoku Cloud. So today, the plan would be to continue with the Keltner channel and beyond, going down below the list. And therefore, let's talk about the Keltner channel. Okay. For that, I'm going to open a fresh chart. I'm going to float it, and I'm going to maximize it, and I'm even going to remove the UFOs I have on the screen. So, oh, sorry, I did edit instead of remove. Here we go. So we have a blank, clean chart. This happens to be the S&P on a daily time frame, but really it could be anything. And then you could go ahead and, if you're interested to insert the Keltner channel, you would just right click to add study and get to where the Keltner channel is. Okay. Now, if you think of channels, and let me plot it first and we take a look, and then I'll come back to the settings. So if you look at this, I would say, probably reminds you, if you've never seen, never used a Keltner channel, it may remind you of a Bollinger Band. Okay. Or if you recall, when we also talked about the Donchian channel a few sessions ago, so if I plot a Donchian channel, it's going to be different, but kind of the same. And just to make it fun, let's add the Bollinger Band, since I mentioned Bollinger Bands a moment ago. So if I add the Bollinger Bands, here we go. Here are the bands. And in the end, you can see there is a lot of overlapping between those three channels because somehow they all try to do the same thing using different techniques. Christian, I see you now in the other room. Wonderful, my friend. Good to see you here. So anyway, so I'm just gonna remove them all, okay, and start again. But if you think about it, they all try to do a little bit of the same, which is to basically identify what is let's call it an average price for the market, which is here, and from there, above and below, those three different techniques are trying to predict or define what too low is or too high is within a specific context. Okay, so let me go ahead and re-add the Keltner channel so we can talk about that context. Okay, because that context is basically in this case looking at average true range above and below. Okay, and it's looking at an average of the high, the low, and the close divided by 3 by default. This is what counts by default. Those are your factory settings, which of course you can change and save as default depending on your preference. Just like the colors and the thickness of the lines, all of these can be changed and then you can save as default. Don't think I need to go over that, but just a little bit of a reminder. And again, basically you have multiple choices. So let's say you want to pick the midpoint of a candle, but giving a little bit of an extra weight to the closing price. So that's what comes by default. Let's say you don't care about the high and the low, you just want to rely on the close. So it's whatever your decision is when it comes to how that average price point is calculated. And from there, you add, in this case, 2 ATRs above and 2 ATRs below, which these, of course, can be changed to be 1 ATR or 3 ATRs or 2.5 or whatever you want. But let's plot it, okay, and see what that is, okay? And as you can see, so in times where the market is relatively, quiet or, behaving, in a pretty, let's call it healthy or pacific, non-aggressive manner. So you can see how the upper part of this channel is acting as a pretty strong resistance line. The bottom part is also acting as a very strong support line. Often the average is also acting as a strong support. These are the times when the markets are more in the normal kind of behavior type of environment, where when the market goes crazy, like in those times, okay, you can see that you are way far away the Keltner channel, and this is kind of telling you that it's a little bit of an abnormality because that is 2 ATRs away from the average, and obviously going that far in such a small amount of time, that means that the price movement is significant, okay, in this case to the upside, or in cases where you are below the Keltner channel for a while, that basically tells you that there is lots of this was the crash in 2020 when the pandemic started worldwide. So this is telling you that the speed of movement to the downside is also very exaggerated. Okay, so how can you use this? Well, basically the way on how to use this is very similar to how you would use a Bollinger Band or a Donchian channel, as we discussed in prior sessions. You may look at situations where the market is either above or below those bands, and again, you could go ahead and the moment price goes below that, because the red line represents two ATRs below the average, so you could call this a very cheap price and you can start buying. Or when the market goes above, you can see that as a very expensive price and therefore take profits. Or if you are more aggressive, short against the trend, you can also do that. Of course, as always, the concept that we explore and we exploit in our training and our courses, and I've discussed that before in the sessions, is the concept of pairing indirect forces together with direct forces, and that's how you add more odds in your favor. And of course, the direct forces are your UFOs. So certainly a very valid way on how to approach it is to turn on those UFOs. Okay, and if you are directional, so for example, going back in time, if you come back somewhere in here, okay, not in here. What about here? What about here? What if we come somewhere in here? Yes. So at this moment in time, you have a UFO here located at 326.80. And when price comes into that UFO, which is beyond this particular calculation, again, we defined that a moment ago. I used the term, this is a very cheap price. Why? Because, it went very quickly beyond what 2 ATR below the average is. So not only you are below the average, you are 2 ATRs below the average. So that, in a simplistic format could be called cheap. And not only is cheap, which is an indirect force, but on top of that, now you are entering a UFO, which is the direct force. And now you have the two components working in your favor, and you can see how price went to the opposite direction. Okay. And this could have been a very good entry point. Now, what's the bad news about this technique is that those entries won't happen too often, because how many pierces you have? Here you have one, but here it didn't pierce, here it didn't pierce, here it didn't pierce. So again, you will miss many trades, but the ones you would take, just like with a Bollinger Band, statistically should be very, very, low price points. Okay, at least in the context of this particular time frame and the average. And therefore, if you're a conservative and so on, this may be a valid way on how you want to approach it. Another way on how you could use this technique, similar to Donchian channels, Bollinger Bands, or any band in general, even though in this case the calculation is not based on standard deviations, but is based on ATRs. The way you may want to approach it is, again, we define the red line as this is cheap. This is your indirect force. Below, in this case, we have a UFO located at 446. So, let's say you are an options trader and you want to sell bull puts. So you could certainly go ahead and sell puts below, and create your bull puts below and expect price to not to go there. And if it goes to that UFO, expect it to turn aggressively to the upside, because not only is far below, but on top of that, you got UFOs to defend yourself. The only thing I'm not too keen about this particular setup, and it's just because, maybe it's no need for me to mention, but at the same time, my eyes are going there and I cannot just stop it, is the fact that with the S&P on the daily time frame, you only have 44% probability, because that market, trades much more intensively in the futures markets, and the reliability of the UFOs there would be way better because orders don't get canceled like the equities, which only trades 6.5 hours a day. So recommendation here is, of course, to apply it if you're going to use direct forces, which is UFOs in this case. So just use it with either a different asset or use a time frame such as 2-day time frame, where now you have a much better probability, and now, of course, you are in a different place on the band in this case, on the channel, I should say. But now you could rely on that UFO here at 440 and do your bull put spreads below that, because again, if price goes below this line, okay, typically you have these beautiful turning points, even though, of course, it's not always. If the event is so crazy, like the beginning of the pandemic, so price may continue going down, but in many other cases, okay, this is indeed a cheap indication for price, and this combined with UFOs could be quite powerful. Okay, this same concept, which I'm using in a 2-day time frame, Joanne, how are you? Good to see you. This same concept that we are looking at a 2-day time frame in this case could certainly be also exploited in intraday time frames if that was to be your style. And talking about the S&P, you have you have Monday and Wednesday and Friday expiration dates for the S&P as well as the SPX. The SPX being a market which is supposed to provide, we'll see about liquidity, but it's supposed to provide liquidity to 24 hours a day for options. So indeed, these could be opportunities for you to maybe drop to a very low time frame, maybe a 8-minute time frame, something like that. Okay, and intraday, every time you have price going below, as long as you have UFOs, do your trade. Okay, like, let me see, what was that date here? So 11:15. So 11:15, if I'm not mistaken. Yes, correct. That was a Monday. That's what I was thinking. So let's say this is Monday. the market is coming down very hard. You have that UFO there at 465. So this may be your opportunity to sell bull put spreads. I don't know if Clive is with us listening. I know you love to play the intraday moves, isn't it? So you are looking at the intraday time frame, looking at this Keltner channel. Price is going very heavy down, close to a UFO. You can sell your bull put spread there. And again, it's not always going to be the case, but in this case, you can see how price reacted and moved in the opposite direction. Didn't even reach the UFO because again, below the Keltner is supposed to be cheap. So in this case, institutional buying showed up even before reaching the below UFO. But the point is, this could be a mechanical way for you to define what is cheap or expensive, okay, both in larger time frames or also intraday, of course, in the context of risk management, because notice how sometimes price will keep falling down, okay, even if you had UFOs, which I'm not sure was the case or not, but price may keep falling down because, you know, you may have a change of climate or something. So again, doing bull put spreads or iron condors or things like that, you have a limited risk by default. So it's great. But again, just make sure you know what you're doing when it comes to managing your risk, because while this increases your probability, nothing that we do as traders is a sure thing. Okay, so I know you all know that, but again, I want to make sure that no one gets overexcited. It's all to be back tested and it's all to be kept under control thanks to risk management. Okay. Joe, just as a note, I find price action much easier to follow on a 2-day time frame. Yeah, definitely. For equities, 2 days is such a sweet spot in the sense that you get much more reliability with the UFOs. You get much less human emotion because now you give yourself 2 days per candle instead of 1 day and things like that. And yeah, indeed, I get you. It's certainly something that has its advantages big time. Plus, you don't really increase the size of the UFOs on a 2-day time frame, so you don't really increase your risk while you increase your odds. Okay, so it's pretty sweet, and this is why we have it with Top, and it's our little secret, if you wish. Not many other platform providers know about that. Okay, so it's our little thing. Anyway, so going back to the daily time frame, just because it's kind of standard. Unless you have any question, I'm just gonna get rid of the studies and go for the next analysis or a next study for us to insert in Top from the list. And I don't see any questions, so I believe I'm just gonna go ahead and remove that, right click and add study. Okay, and now we're gonna go for the next one, which is the moving averages. Okay, well, this one, I guess we can, in one hand, we can talk about it for hours. In the other hand, we should spend seconds to talk about it because I would expect everybody to understand moving averages and what they are and how they work. But in any case, when you right click and you add a moving average, so what you'll find is that first you need to set up your length. How are you, Ahmed? It's good to see you, my friend. You can set up your length. You can also set an offset in case you want the average to be plotted with a delay. Okay, this could be useful if you have certain rules where you may want to base maybe a stop or a target or something like that based on the prior candle, meaning that you don't have moving prices either during that candle is trading, could be intraday or daily or weekly. So this could have an advantage. Okay, at the same time, studies in general normally add latency to your trading decisions. So adding an offset is even more. So I personally am not a fan of that, but certainly the functionality is there in case you find it useful for anything. Now, the type of EMA that are the type of EMAs that are the type of moving averages that are available with Top are EMAs, which is exponential moving averages, which are simple or SMAs, simple moving averages, which are the most classical ones, if you wish, or weighted. Okay, and this is kind of like going from slower to faster. Okay, so I was talking about the latency added by studies or indicators in general. Well, if you go for weighted, you have less latency, you have more weight to the real-time price action and less weight on the older candles. So you have less of a latency. With the exponential, you have a little more, and with the simple, there is no weighting at all, and therefore there is the maximum latency, if you wish. Now, you could argue that the simple moving averages, okay, if I plot one, in this case, let me go ahead and make it very large, okay, so we can see that well on the screen. Okay, so you can see here the simple moving average is pointing at 467. So if I right click and edit the study, okay, and I change that from simple to exponential, okay, so click apply, and now it's a bit closer to price. And if I click on weighted and I click apply, it's now even closer to price. So that's what I meant. Okay, it's you're pushing price to be closer to your study, or you're pushing your study to be closer to price, which is the same thing. uh, and basically you're removing latency. But at the same time, you could argue that, if you want to rely on what an average price is, the kind of like the real average would be the simple, in the sense that this is an average of price, okay, with no tweaks, right? So if you do 9 simple, it means that you take 9 candles and you add up the price, in this case the closing price, and then you divide by 9. So it's the real average, so no tweaks. So it's the real average. Okay, so if you're looking for real average, I would say go for simple. If you're looking for some sort of an indication that helps you to take a decision, maybe the weighted is the best because you got the least amount of latency. And maybe if you're going for somewhere in between, maybe the exponential is the best, okay, which is the one we happen to use in our future sessions, Forex sessions, stock sessions, option sessions. We often use an EMA as a reference. And the reason is because, again, the EMA, if you look at the prices, if I look at simple, it's 467.27. If I look at exponential, it's 467.42. So the difference is very little. So because the difference is very little, but you have a little bit less of a lag, so it seems to be like the sweet spot when you need to take a decision. Okay, and again, it's not like this is a magic thing. It's just an observation, and you may agree, you may disagree. The key really is not that those EMS or SMS or WMS happen to be magic. The key is that whatever you use, you keep it constant. It's part of your trading plan. You have backtested. You're happy with it, and that's it. Because in the end, a moving average is a moving average. Okay. The last comment I'll make here is about the source. Okay. Some of you may be using the EMA as a maybe you want to calculate, like, let's say you are a financial analyst, or maybe you work for a company and you are looking at the price of the S&P and you want to hedge, or maybe you're looking at the price of a currency, you want to hedge and you want to know a real average price of something. So maybe it would be smart to look at the high, the low, plus the close divided by 3. Look at this to be simple, and maybe look at a longer period. Maybe in a month you have 21 trading days, so you do the 21 simple average of the high, the low, the close divided by 3. And this would tell you that 463 is kind of like a real average price. So maybe you are a finance expert, you are a hedger, you work for a finance department in a company, and you apply this to the price of crude oil or the dollar index or something like that. And this would be a nice way to get, like, some relevant price point that may act as a very strong support in certain conditions, because it's really an average price of an average, because you have the average of the source and a simple average of a very significant amount of days. 21 days in a daily time frame is a month, so it's the monthly average. Those things are relevant for this type of professionals. But again, maybe what you're looking at is not that. What you're looking at is, you just want to react to whatever is happening now, which is the close, and you want to react in a very short-term time frame, and then you do 9 EMA, which is what we do in most of our sessions, which again, has pros and cons like everything else based on the rationale I share with you. Okay. Last thing, which is known, you can save as a default, or if you want to go back to factory settings, you just click factory settings, and the moment you save as a default, whatever your settings are, every time you import an EMA, a moving average, it will just be, in this case, an EMA 9 with black color with a thicker line. So whatever you have customized, it would be then saved as a default. Okay. Cool, that's an EMA, okay? And I'm just gonna remove it because what I'm gonna talk about now is the moving average envelope, okay? Which is based on averages, but as you will see, it looks like channels, okay? So when you click moving average, and I'm just gonna go back to the settings in a moment. If I click OK, notice that you have price points above and below, and it actually looks like an envelope, okay? So you would be like, okay, so what's that? Okay, and notice that, when those lines are being hit, it really means the market has moved like crazy, because since 2020, we never surpassed any of those lines. Okay, almost here, but we didn't. And even with the crazy move we had where the AutoClimate got crazy from a statistical point of view, we never went above that. Okay. So does this make it useful or not useful at all? Well, it depends, because first of all, you can edit the settings. Okay. And this basically is calculating moving average of the high price and moving average of the low price. You can change all of that, of course. Okay. And then it's pushing it higher by a coefficient, +5, -5 in this case, which you could reduce. Like, let's say you want those ranges to be a bit less exaggerated. So you can make this to be -3 and +3, for example. And if you were to do that, notice how the channel shrinks, as well as the EMA. Okay, the shorter the EMA, the more reactive the channel is going to be, and the more it's going to move. And the smaller the number you choose, the less reactive it's going to be. Okay, so again, you may adjust it depending on the markets that you trade in a way where you can use it similar to what we saw with the Keltner channel, where when you got pierces below or above and you have UFOs, you can get entries, okay, like here and like here. Okay, so you can get entries. This could be one way, or targets when you got pierces like that. Okay, or you may want to adjust it similar. And let me do this. Okay, you may want to adjust it. Let's say you are doing, let's say today is Friday, and you are doing an iron condor into next week. So how many trading days you have? 5. Okay, from now until the next expression day, you have 5. So you may want to calculate what's the average on the last 5 days of the high and the low, and then you may want to project it. I'm going to start with 1, so you see the effect, and then we'll do 2. Okay, when you do 1 above and below, basically this is telling you what you would where you would expect. It's almost like trying to predict where a price will be. Oh, sorry, I just clicked on the wrong place here. So it's almost trying to predict where price will be, right, in the future. So if I go back to so today is 19, here we go. So this was last Friday. So this upper price would be the prediction of the size of the range into 5 days later. Okay, and if you look at what happened, then the prediction changed, but price stayed within the lines in 5 days after. Of course, it's not always going to be the case. If I go back to a date where the market was trending very heavily, okay, so for example, if I move here, okay, on 10:15, which was kind of like the beginning of very aggressive moves, right here. Okay, so actually you are already beyond the prediction, so that prediction is not useful at all because the moves are so strong already. Okay, so somehow you are killing 2 birds on 1 stone by using an envelope of this sort. You are assessing if the market is trending too strong for a non-directional trade or not. And for example, if I go back to the next Friday, okay, so this would be, yeah, next Friday would be here on this one. So here, you are within instead of outside, you are within. So you could say, okay, time for a non-directional trade. Now, of course, when the market is trending so strong, and again, this also has to do with the fact that was making all times high. There were no UFOs above because that's the S&P, but it would look different with a stock. Okay, but now you can look at what happened, and then onto the next Friday, you broke that expectation of a move. Okay, so again, you could work on different settings. I'm going to go back to this date in a moment. Okay, this could be useful as a trend strength indication. So if you are breaking your range, it means the trend is very strong. And if you are within, you could use that as a predictor of a range based on the average price movement and that shift. If you want to be a bit more generous, okay, with the size of the ranges, you can make it +2 and -2. And now if you do it like that, okay, and we go back to the example we had here that didn't work on October 22nd. Okay? So now your prediction of the range would be all the way here. Okay? Now the ranges are wider, so of course now the premiums you're going to get paid for those trades are going to be much less. And the trades may or may not be worth it because you're taking less risk. Okay, but now notice how we went to the next Friday. Yeah, that was there on the 29th, and we were still within the lines. Okay, so again, you could certainly use those envelopes, number one, as a technique, okay, to detect the strength of the trend or as a technique to predict a range. Best to be combined with the UFOs as always, because you have your indirect force and your direct force. I personally prefer to work on the climate because here is just a price projection based on the average of the last 5 days. So there is very little stats built in this, but 5 days. With the AutoClimate, for example, you have much more interesting statistical analysis carried through. And also with the max distance, you also have a measurement of the trend condition and so on. Also, when we are doing our live sessions and we look for ranging markets, we're using the matrix and we're using the DT strength, which is another tool we'll discuss at another time. So I would not say this is the best way to do it, but for sure it's very simple, it's very visual, and it could be something that works for you. So I'm just sharing possibilities on how you can use it in case you want to play around. Also, I know some of you are very much in the perfectionist side. So maybe you are looking at your AutoClimate, but then you have a second validation with a moving average envelope in case that's what you're doing, okay? So just sharing a few alternatives, in this case, one, which is derived from the use of moving averages, but in this case, the high and the low, not the close, and then projected above and below with that coefficient, we call it the shift, okay? Fernando, these moving averages for envelopes are simple or exponentials? They are simple. Christian, Jose, your iron condor setups never use the envelope. Why is that? Oh, you heard me? Yes, because I mean it's certainly a valid way to do it, okay? But again, I prefer to do it, the other way. Also because when we utilize on top, apart from the technicals on the chart, okay, Christian, when we utilize this, we utilize the spread select. Okay, we utilize the spread select. We often pick up strike prices that have price anomalies that are giving us an advantage, and out of that, we go ahead then and we calculate the break-even points. And if those break-even points are beyond this calculation, which, by the way, I'm going to cover in a moment, which is the probability cone. So then, to me, it's a much more precise / elegant way versus just running an average of the high and the low of the last 5 days and whatever. Also, it would be very tedious because if your iron condor instead of 1 week is 2 weeks, now you need to go ahead and tweak the envelope or have 2 envelopes on the screen, get another one, okay? And then the other one, instead of 5 days, you're going to make it 10 days because 10 days is 2 weeks, okay? And again, we were using +2 or -2. So if I do that, so now you have 2 different envelopes, and now is what, and it becomes, difficult to assess on the screen easily. So I by far prefer to do it the way we do it. But again, this is an alternative, okay, which could be interesting. And also for the ones of you doing this intraday, which I know some of you are, have as a routine on the, sorry guys, here we go. I was just erasing the lines and not multitasking very efficiently. So some of you have this routine where you are trading the SPX options. Okay, let me insert the right symbol. Okay, so you are trading SPX. Okay, this is an 8-minute of the SPX. Okay, this is not the SPY ETF. This is the SPX. Some of you may be trading SPX options. Some of you may be trading the SPY because they provide Monday and Wednesday and Friday expression dates, and you are playing that intraday. So again, you can certainly add that. Okay, your moving average, okay, envelope, okay, and do a calculation, okay, of what an envelope is for you, and just do the same thing, okay. So again, how can you do a calculation? So how many candles do you have? Okay, like let's keep it simple. If I look at the SPY, okay, you have 6.5 hours of trading in a day. Okay, so 6.5 hours of trading times 60. That is 390 minutes divided by 8. Okay, that's 48 candles a day. Okay, that's 48 candles a day. Okay, 49. Let's call it 50. So you can go ahead and play with this. You can insert a moving average envelope. Okay, calculate the 50 average. Okay, the 50 average. Okay, and then project that. And of course, you need to experience with this and backtest it, but you can go ahead and do something like this, okay? And this would basically define a statistical range, okay, for the day, okay? So now let me look for, so 9:30, that's when the market started trading on that particular day. So 9:30 right here. So this is the starting time of the day, okay? So at this moment in time, you can be looking at the bottom part, and you know the last day the S&P was relatively quiet, so it's not like it moved that much. But you could be looking at, you know, the bottom part of here, which is 463, and the upper part of here, which is 473. And for the ones of you playing bull puts and bear calls or iron condors intraday using Monday, Wednesday, and Friday expiration dates, so these could be price points which are relevant to you, and then you go find UFOs above and below. Okay, you turn on your UFOs and you rely on those, expecting price. You know, for example, that UFO here. You know, again, I will need to rewind the market to this point because we may have other UFOs available at that time. Here we go. So those UFOs here are within the envelope, so you will not rely on it. So that day, because you are kind of making all times high and there is nothing above, so we just play the bull put side and not do the bear call. Other days in the past, okay, where you may have had UFOs above and below, you play both sides. Okay, you do iron condors, or you know, if you only have red UFOs but no green UFOs anywhere close to the bottom line, you only play the bear call side. So all of this is to give you a reference that makes you mechanical. It's a smart calculation. If you're going to use it on a one intraday time frame, the way I'm doing it, it's really very simple. So it has an advantage, and that's why I'm mentioning this to you, for you guys to you know, maybe spend some time with it, backtest it, and see how it works. Because often I find intraday traders having a tough time to define what's high and what's low for the intraday session. So this could be one very easy way where you don't need to do any mathematical projection calculation. That's it. You have it right there. That's it, done. And it makes sense. Okay. Now, in the other hand, of course, it's just a reference point. The value of this calculation is to serve as a reference, really. This is not a strong indirect force. It's not like the 20 EMA on the daily time frame that many fund managers will use for their trades. This is just a calculation that serves to you as a good reference for your trades, but it's not like you should expect many more people in the world use that reference. So you would not want to use that as a resistance or a support. Price actually is almost never reaching there. So it's just a reference for you to sell premium on the other side. And, you know, ideally, and, you know, you would expect in several cases to be good to go when it comes to having those options expire at the end of Monday, Wednesday, or Friday. Okay. So that's my 2 cents on the use of moving averages envelopes. Okay. And not sure if Clive is with us today or anyone else feels that this is interesting or useful or got you thinking, but I would love to hear your comments on the chat box. I'll take a sip of water in the meantime. Certainly, I'd love to hear from you guys. Okay, so I'll be reading the chat box in just a moment. I'll do some cleaning on my screen. Let's remove all studies. Let's remove all lines. And let's continue. Christian is going to experiment with it. Very good. Very good. Perfect. Okay, so add study. Next one in the line is the options volume map. And that one is another tool, just like the UFOs, we have a patent. So the options volume map also has a patent. You can see the number here. This is powerful stuff, okay? Powerful stuff. And also remember, the volume map is also something that can be scanned real time for using the matrix, okay? So I'm just gonna insert it very quickly here, and I'll come back to the settings in a moment. So here's your volume map, okay? Here's your volume map. But also I wanna go back to the matrix and very quickly show you that on the scans, you have the options volume map, and you can be scanning for specific conditions in here. Got you, Joanne. No worries, all good. Thanks for that. So, so here are scans that you can then perform. Okay, so when we cover the matrix with detail, for sure, we'll talk about this again. The moment I'm just going to talk about it from the point of view of what you get on the chart, but just know that then you can search for it. Okay, so that's important stuff. So now, what do we have here? Well, if I load it by default, so because I have my settings, okay, so if I edit study, okay, I have this window here where I can do different things, and I save as a default what I like to use myself. So because of that, it shows probably with a different color and different quantity of data on the screen compared to you. Also, this is the S&P. The S&P is the most liquid market out there. You have expiration dates plenty, including Mondays and Wednesdays. So we have so many, right? So notice what happens if I load, let's say, Facebook, which is also very liquid, but doesn't have that many expiration dates. So what's going to happen is that you still got, plenty of those maps, but basically you got 5 in my case because of my settings, where again, if I go back to SPY, I get 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Okay, I got 14 of those maps. Okay, so again, why is that? Well, that's because the amount of expiration dates available on the S&P, okay, is humongous. Okay, you have November 22nd and 24 and 26 and 29 and December 1st and December 3, where if I look at Facebook, okay, the amount of expiration dates are much less, even though it's a very liquid instrument, but they are much less. This is the normal thing. Friday expiration, that's what we call weeklies, and then Monday expiration, which is the third Friday of every month. Okay, it's also a Friday, but because it's the third one, we call it monthly. A few more differences, but that's basically it. Okay, that's the normal thing. Like 99.99% of the instruments in the market are like that, but the S&P is not. Okay, so that's why I have so much data on the screen, which is probably too much. Okay, so I'm gonna switch to, let's say, Microsoft, for example, which is also super liquid, but I'm gonna get less data on the screen. So then we can talk about it in a way that is a bit more realistic. For the S&P, to be honest, I would have a specific setting for the S&P only, because really it's so rich on expiration dates that you will want to have a special setting for the S&P only. Okay. Sorry guys, I'm very thirsty today after watching the race. Anyway, so what is it that we see? Okay, so first of all, I'm going to show you what we see, and then we'll talk about settings. So when we look at the volume map, okay, the first thing that you can see is that by default is going to show the word volume, okay, and then dates. Okay, so those dates are the expiration dates, and the word volume represents that the data that we're going to see below, every one of those, let's call it columns, are going to be information that represents volume. Okay, quantity of contracts traded, which is volume in the case of options. Now, apart from the data we got on the top that refers to volume related to that expiration date, which is November 26 in this case, we also have a smaller box on the bottom part, which also represents volume because we have selected volume. Okay, but now what we see here are bars, and we got 5 bars to be precise. Actually, we got 6 bars to be precise. And then we got those little triangles. Okay, so what is all of these? Okay, and then on top of that, we got colors. We got blue and we got gray in my case because I changed the colors. Okay, they are not the standard colors. Okay, your screen will certainly look different if you have the factory settings, but you can certainly change it to look like mine or any other color you prefer. Okay, so what is all of this? Okay, and on top of that, if I click where it says volume, I click, then volume changes to price. If I click where it says price, it changes to strike. And if I click again, it goes back to volume. And then if I click on the upper part where we have the date, okay, and you can click, it shows OI, and the colors have changed. If I click again, we go back to where I was, it shows CV, and the colors are back to where it was before. So what is CV? CV means contract volume. So this is volume. And if I click and it says OI, then that shows open interest. Okay, so we are looking at the open interest and the volume, and we can just click and change it. Okay, so you are in volume mode or open interest mode. So in other words, the volume map, to be honest, it's 2 maps in one. you could call it the volume map or the open interest map, depending on which one is the view. Where did you click? Okay, and then no matter if you are in open interest or volume map, then remember you also have the choice to click below, and then it will show you the price of the options, the strike, or the open interest. Again, if I go back to click above and it's contract volume, I have the volume. If I click on volume, it shows the price. And if I click again, it shows the strike and then rotates back to volume. Okay. So basically you have all that information available, which I want to re-explain better. But also before I do that, I want you to notice that that information is lining up with the price scale. So for example, if I point at 350 on the right, whatever information you have aligned with 350 represents the 350 contract, I should say 350 strike. And if I get more precise, on the left is the 350 calls, and on the right is the 350 puts for that expiration date. So in other words, now we can understand that we got 8,633 contracts traded, and to be precise, those were the 350 call. So 350 calls were traded on the last day, and 118 350 puts were traded on the last day. I know those are puts because they're on the right. I know these are calls because they're on the left, like on an option chain. I know they are the 350 strike because it's lining up with 350 on the screen. And I also know is the 26th of November expiration because that's the column I picked. Okay. Now, if I go back to click volume and it changes prices, I change to price instead of volume. So now I know that the 350 call, it's currently trading at 70 cents per contract, where the 350 put is currently trading at $7.44. If I click on strike, now this confirms to me that this is the 350 strike, which to be honest, I don't need to do because it's lining up on the right. But if you were to play and mess up with scales and other settings, as you will see before, as you will see later, this is always a way for you to reconfirm that this belongs to the 350 or the 242.5 or whatever strike you are pointing at with your mouse, if you wish. Normally, the setting of volume, it's going to be the most useful, or if you are using the map with the open interest mode, then the setting of open interest will be the most useful because you can always look at the prices of the options, but I would think that typically you would do that on an option chain, even though it's, to be honest, very handy that you don't need to go use an option chain. You would probably love that, especially if you are a brand new options trader, you never traded options before. This is probably way too overwhelming, okay, for new traders. It's very confusing if you've never seen that before. Now, having said that, if you have been trading options for years, probably you cannot live without an option chain, so you would prefer to look at the prices on the option chain instead of looking at the prices on the chart, even though you could by clicking here, and now you have the prices on the chart like they show on the option chain. Actually, they are upside down because on the chart, the higher prices are above. 350 strike is above the 320 strike, which is below, where in the option chain is inverted. The 320 is above and the 350 is below. Okay, so in the end, is whatever you get used to, whatever is your preference. Indeed, it's a great advantage to be able to have it on the screen. Okay, now let's go back to where I was. Okay, another note, another comment I should make, which I haven't, is that my settings are blue color is the call side, gray color is the put side. Your settings may be that green is the call, or blue is the call, red is the put. Again, all of this is customizable, but my setting, it's blue, the call, gray, the put. It coincides with blue is my up candles, gray is my down candles. So I kind of use the same color patterns in this case, just my preference. But again, that's your call. If I switch to open interest mode, orange is the call and gray is the put. Okay. Just so I know when it's orange, that is not blue, meaning it's the open interest, which is not the volume. Again, all of this is personal preference. You can set it up however works best for you. Okay. What else? Going down. Okay. Now that we know that all of those are the contracts traded for the calls for different strikes, and all of those are the contracts traded for the puts for different strikes, we can also see that there is a ratio which is a number, which is colored, and then that ratio got a little triangle, in this case pointing to the left. And in other cases, okay, let's see if we can find a case where it's pointing to the right. I'm loading another chart. Not here. What if we look at another chart? Not here. What if we look at another chart? This is going to be Murphy's Law. And now we're going to get none. Okay, we got one. So here, for example, you can see how the ratio, it's gray color instead of blue. And then the little arrow is pointing to the right. Okay, so what does that mean? Well, this is your call-put ratio. And basically, in this case, 4.3 means that we got 4.3 times more calls than puts. If you do the math, 7,400 plus is 4.3 times more than 1,700 plus. That's what that means, okay? And when one side wins, that's when you got the triangle and also the color. So because the call side wins, it's blue. When the put side wins, it's gray. And then you got the triangle pointing at the other direction, okay? So this is telling you the quantity of calls that were traded versus the quantity of puts. And indeed, it has a lot to do with a potential directional bias on that particular stock. So short term, okay, from now until November 26, you can see that 4 times more calls were traded than puts. So that looks quite bullish to me, especially when you now look at the bottom part of the screen, which I haven't explained yet, where we have 1, 2, 3, 4, and 5 bars on the left, blue or gray below. Okay, 5. Those 5 bars are being used to calculate the average volume, which is the meaning of the triangle is the average volume for the calls and the average volume for the puts. And then you have the real-time volume for the calls and the real-time volume for the puts. And in this case, you can see that both cases, the call and the put, are above average. Okay? So both the calls and the puts are above average, which a little bit of negates, each other, because if both are above average, so it means there is a lot of trading in both cases. But in any case, you got 4 times more calls than puts, and the call volume not only is more than the puts, but is above average. So that says a lot about the bullish sentiment that is building up. Now, of course, if you were to read beyond that, you can see how the next expiration date, which is 1 week after, actually doesn't have that much more calls than puts. And the calls are not surpassing the average of the last 5 days, where the puts are surpassing the average of the last 5 days. In other words, you could interpret that with Coca-Cola, which is the stock I'm looking at the moment, there is some bullishness expected into the next 1 week, but into the week after, there is certain level of fear, which probably is, attracting people to buy a decent amount of puts, many more puts than in the prior days. That's why today is above the average, but the prior days is not. Okay, so you would certainly plan to take profits, towards the end of next week, if that was to be the case, and if nothing was to change and this pattern was to repeat every day, because the volume map will represent the trading of each day, which is different each day. And talking about each day, I'm going to go back to Microsoft just because it's more liquid and we got more data on the screen. Talking about each day, just like the platform has the training mode available where you can rewind the market, the volume map too. So you can grab this vertical line, click and hold, and go back to any date in the past, for example, that date, okay, and look at, what was happening that day, okay? And you can see, for example, that day, the calls were way above the average, 6 times more calls traded than puts, okay? And more calls, above average, above average, above average, above average, right? For multiple expiration dates. So that would tell you that, there is plenty of bullishness and probably, very likely continuation of the move. So, this is kind of a very healthy confirmation of what to do the day after, okay? In that particular case, so we got a gap up, okay? And now the question is the move likely going to continue in the following days? The answer is yes. Okay, we got 2.7 times more calls than puts, above average. So the answer is yes, but um, not forever, because you can see how here we are not above the average any longer. Okay, where we are above the average on the put side. So, until December 10, I guess market participants for Microsoft are quite bullish, but not so much more beyond that. Okay, so again, you could use this volume indication, and that's why we have it as a scanning option on the matrix, because you can use that tool as a tool that tries to predict what is the likelihood of the market to continue moving in that direction. Okay, the direction of the color of the candle, if you wish. Okay, so in this case, the candle is blue. In the case I picked before, the candle was blue. So, if the color of the candle coincides with those readings, so you would assume, yes, indeed, we are expecting the move to continue. Okay. Fernando, can you explain again the difference between the last bar of the histogram and the prior 5? Yes, the prior 5 are just telling you what happened in the prior 5 when it comes to volume. And the triangle basically happens to be the average of that. So if you take that quantity of volume, that quantity of volume, that quantity of volume, that quantity of volume, and that quantity of volume, you add them up, divide by 5. So that triangle is the average volume of those last 5 prior days. So now you can compare today's volume versus the average of the last 5 days. And 5 days in trading is a week, okay, in equities. So it's a relevant quantity of volume. And if you are above that, and the call size is greater than the put side, or vice versa, this is telling you, again, it acts as a very smart predictor of what the likely move is going to be, meaning that are you going to have continuation or not, from that angle. You don't see that on the candles only after the fact, because those players are buying the options, expecting assignments, exercises, buying or selling options, based on all of that. And just like the implied volatility of the options is a good predictor of volatility, this is a good predictor of continuation of the move from in future candles. You can actually use that. For example, let's say the market is crashing very hard, okay, and so the market is crashing very hard, for example here, right? So market is falling very, very hard. So, notice how we got more calls, okay, and above average, okay. Now there is still a bit of fear in some expiration dates, okay, but everything else, even though the market is going down, is showing more calls. So this is telling you, hey, this is falling, but it doesn't look like it's gonna fall forever. There is bullishness coming in. Of course, don't use it by itself like that. Just plot the UFOs. Now, maybe, you were looking at that particular candle, and below that low, maybe you are in a speed bump. Here we go. So you're in a speed bump area, blah, blah, blah. So wait for a bit more evidence. And now, and you have UFOs, okay? And now when price comes and shows you blue, now you look at it, and now, yes, now not only the movement started, now you still have those values, and across the board is all blue, and you are above average across the board. So this is telling you now likelihood for price to continue. So if you are a breakout trader, above the high from the prior day, get in. If you are not a breakout trader, just look for some UFO. Okay, so let me go back in time to here. Let me activate UFOs. Not sure if we'll have or not. Here we go. You have a UFO. So now wait for price to come into the UFO and take the trade. Okay, which is, what happened later on. Price came into the UFO, and from there, price went. Okay. Again, it's not always going to be like that. Manage your risk. Make sure that every trade has a possibility for it to profit and a possibility for it to lose. But definitely, all of these are tools to stack odds on your favor, and you are basically reading from behind the scenes, because you are basically trying to get what's going to happen before what's going to happen is visible, based on candlestick price movement. Okay, you are getting that information from the derivative markets, from the options. Okay, so so keep all of this in mind, because it's quite relevant. Now, another last thing I'm going to mention about this, which is the open interest. Okay, so the open interest is quite interesting, especially when it comes to understanding key supports or key resistances. Okay, so for example, if you load the volume map and you kind of, let me try to make this a bit larger. Okay, so if we look at this like that, and it's a bit larger. So what catches your attention? Okay, what catches your attention? Well, if you ask me, this catches my attention. Okay, this catches my attention. That one too, which is in the same place. That one too. Okay, that one is also pretty interesting. Okay, that one less. Okay, but kind of. And in other words, if you were to stretch this to the left, so we are talking about here, and we are talking about here. Okay, in other words, we're talking about 350, and we are talking about 340, if I'm not mistaken. Yes, so 340 and 350. So out of all those strikes available, 340 and 350 happen to be strikes where through times contracts just keep being added, and therefore the market understands the relevance of those price points. So now, how can that be used? Well, let's say you got into a trade and that market is making all-time high and you have no idea when to take profits. Well, I guess you would agree with me that 350 may act as a very strong resistance where the market turned against. Okay, if we go back in time, and for example, we look at, let's say you got into a trade here on that day when the market retraced. Okay, and you look at, what were very strong price points. Okay, so here you got one, and yeah, I would say that's it. So here you got one. Okay, so maybe you would have set up some sort of a target right here. Okay, so some sort of a target right here, and when price rallied, retraced, and kept going, and went here, then you got out. Okay, and then it continued, of course, because we don't know what we don't know, and I mean probably it continued because if you add the AutoUFOs, so and you rewind a little bit, I'm not sure about that, but maybe price went to your target, okay, and now you are out. But the reality is that UFOs are below price, so when price came back below, it kept going because it reacted to that UFO. So this is something that will happen. So you can work on your targets dynamically, putting on the side that when you got to the target on that day, that could also be a tool to try to maximize your profit taking. So when you got to that tool that day, if you were to look at the volume map on the prior day, well, actually, that strike still had plenty of open interest. So, it would have been wise from a safety point of view to take profit there. Okay. But you can see how a new strike is building up at 350. So maybe, that was your target one. And then you decide to maybe take partial profits only and not to close the whole trade and go for 350. That is a new strike that is showing up in the unknown territory of the all-time high. That 350 strike is showing up as possibly or potentially very relevant because it keeps accumulating open interest. So many people are trading options at that strike, meaning that price point is relevant. Okay. So again, this could be used for profit taking in cases of all-time high situation. This could be used as an enhancer of probability if you have multiple UFOs and one of the UFOs below, let's say you want to buy. Okay, so the market is falling that day. And you are like, okay, I want to buy, but I'm not sure, what is the right price for me to buy. Well, actually, the right price was right now, right there. So maybe I'll do the analysis the day before. Okay, so let's say it's that day, right? And you're looking at the volume map at that day. So notice how there is pretty strong volume there. So if I was to enable AutoUFOs, and again, you may use multiple timeframes. So then it may not show. I mean, the only UFO I have is here. So in this case, it would not have worked. But let's say there was a UFO a little higher and it was lining up with, this interesting quantity of open interest. So this is telling you that not only you have on-field orders awaiting to get filled, but on top of that, you have a potentially very relevant support area, which may be very attractive to many financial analysts around the world. And that's located there at 330. So when we look at what happened later, so price did come here to 330, and from there in this case, it bounced. Okay, and there was no UFO in this case, so the indirect force was powerful enough. But to make it better, if you lining up with a UFO, you would think of seeing better results, isn't it? I guess it's common sense. So Ahmed, to make it easy for me, I look at it if it is 1.5 or greater. Yes, correct. And to be honest, this is how it's set up on the matrix, which we'll talk about in a different session when we talk properly about the matrix. But on the matrix, when you scan, you are looking at an imbalance of at least 1.5. Because if the imbalance is less than 1.5, really, there is no imbalance. Okay, there is no call winning versus the put or put winning versus the call. Okay, so here you have the call imbalance winning on the current monthly expiration date, and then you also have the next monthly expiration date, the imbalance winning, meaning that shorter term trade or swing trade for a few days only, or swing trades for multiple weeks, and that's on the call side, and then same on the put side. Okay, so that's basically ready, automated there. We'll talk about it when we talk about the matrix. But again, this tool is very powerful, and there is a patent on it for a reason. Again, you can certainly combine it in different ways, and you cannot plot it, by the way, on intraday timeframes. If I type 60, for example, it will just not show. You will only have the candles, but you will not have the volume map. But you could certainly run it on the daily time frame, get the values that are important to you, okay, draw a horizontal line, for example, and then drop to a lower time frame, and you will see it. Okay, now from a setting point of view, okay, I'm going to cover that, and we'll call it a day. So I'm going to edit the study and go for option volume map. So from a setting point of view, the first thing you can change, even though it's easier to change with clicking here, but you can change, you want the volume up to volume or open interest, okay, or price volume. Okay? So you're gonna go for contract volume. How many strikes you want to show above and below? Okay, in this case, I'm using 3. Let's say you really want to chart many strikes, you can select 10. Okay, but now it's gonna take a long time to load, and it becomes larger on the screen, because remember, the volume map is showing the data in sync with your price scale. So now it's shrinking the chart so everything fits on the screen. Of course, strikes that are very far away are going to be not so relevant. Even in liquid stocks, look at that, you only got 9 contracts. So again, it doesn't make sense to load that many strikes in my mind. But again, that depends on what you're trying to do as well. How many months out you want to load? Again, let's say you are doing short-term swing trades, so probably 1 month out is good enough. But also, what if the next month expires next week? So I particularly like to load 2, so I can see front month and next month. If the expiration date is expiring in less than 2 days, you can go ahead and hide it, or maybe you only want to hide it when there is only 1 day left. All of these are settings that are your choice, and then you click OK, and it will basically apply on the screen. Number of weeks out, let's say you tell me, I don't care about weekly expiration days, I only want the monthlies, so you can just go ahead and uncheck that. Okay, and now you would only have monthly expiration dates. It's only 2, you don't have weeklies. Or maybe you want weeklies, but if the weeklies are expiring in 2 days or less, or 1 day or less, then you want to hide them. Again, all of this depends on your application. You can also display the expiration dates on the actual date. That's going to push those graphs all the way to the appropriate date into the future, just like the strikes are aligned with the price scale. If I select display expiration on actual date, it's just going to push the whole thing very much to the right, which is very cool, but it may not be that convenient. So if you want to have all on the screen that fits well, so you may basically need to give up on seeing the candles, right? Because of course the January expiration date is very far away compared to December, so you have to really push for these to be on the right date. Okay, and basically you are giving up on the candles. Okay, so I'm not a fan of that setting, even though it's there, and this is something that again you can also use or not, depending on your choices. Okay, this display expiration date background means that you want to have that little shaded color in the background or not, or the labels. Do you want to show labels or not? Or do you also want to show the historic volume or not, which is the bottom part? And finally, the font size. Okay, so if I was to pick font size to be, I'm just going to be exaggerated, 21. So notice how everything becomes very large. I would say not a good idea, depending on what you have on the screen. The width factor also has to do with making those boxes larger or not. So all of this is to be customized to the resolution of your monitor, depending on what is it that you like or not. Because if you make it too narrow, then maybe it's very neat, but then maybe you cannot read the values inside, or the size of those bars, lose their meaning. So depending on the size of your monitor, the resolution of your screen, all of this is to be adjusted. And also the offset, okay, it's to create space from the last candle on the screen to the right, to create space so those bars actually fit. Okay, so all of this is again to be customizable, as well as the colors. And once you have it the way you like it, then you just click save as a default, and then every time you load it, it's going to be like that, which is what I've done with my colors and everything else. Or you can just go back to factory settings if you prefer the factory settings, or you just kind of got confused after so many tests and you want to start from scratch again. You can just go back to factory settings and start again. Anyway, my friends, so this was today's session. Lots to talk about, isn't it? When it comes to the platform with so many features. Yes, correct. The offset is critical, because then if not, basically if you don't have an offset, so you load the chart and the information would be hidden on the right, and every time you have to drag it, which is uncomfortable. Okay, but anyway, again, it's all of these depend on your preferences. Okay, so I would certainly invite you and suggest that you guys play with it and have fun and make it yours. So when you use it for trading purposes, you have an easy time looking and finding looking for and finding the information you're looking for, depending on your trading plan and so on. Yeah, my settings, of course. So let me go ahead and remove and add study one more time, so you can see the settings I have as a default, in case that is a good reference for you guys. Definitely happy to share. So let me take a look at your final comments there. Fernando, awesome session. Thank you so much, Fernando. Thank you so much for that. There is so much to talk about, isn't it? I mean, it's. I wish I could compress everything in 1 hour. I mean, putting on the side that indeed, I use time to explain things, but and I could make it shorter, I guess. But at the same time, I want to give you all the details, and there is so much to cover. So I appreciate you guys to stay with me, to be patient. I appreciate your commitment and everything else. And believe me, you're gonna have many aha moments with Top, and it's gonna be fun. Mark, can you show your settings? I did that already. Ahmed, enjoy the rest of the Sunday. Same to you, my friend. Joanne, yes, we'll review again in an hour. Like this last part is exactly what I needed. Wonderful. Thank you so much, Joanne. Christian, thank you as well to you. And everyone else, thank you so much. I will see you next week on the Wednesday. You probably saw on the calendar next week is going to be a bit less busy with Thanksgiving. So I will see you on Wednesday, and I will wish everybody a happy Thanksgiving then. In the meantime, as Ahmed said, enjoy the rest of the Sunday. Take care, my friends. See you soon.